Welcome to It's the Economy. The US Fed did not cut rates as expected, but has sprung a surprise in terms of reducing the number of cuts forecast this year to 1 from 3 earlier. US bond yields didn't rise much because they are still elated by the lower than expected May inflation number, CPI number, at 3.3 versus estimates of 3.4. More important, the Indian inflation number has also come in lower than expected, with core inflation going down to 3%. So what's the way forward on US economy, US yields and the Indian economy? I have with me Jahangir Aziz, the chief economist for emerging markets at JPMorgan. Jahangir, I'm really grateful for you for staying up for us. So let me begin first with the Fed. It admitted that inflation fall is making progress, but it has reduced the number of expected cuts. What are your key takeaways from what you heard from Powell?
Last Friday, when the non-farm payroll surprised on the upside, we moved also to 1 cut for this year. And we had 4 cuts for 2025. So we broadly kept the number of cuts. We just pushed it back to 1 cut for 2024. And that was beginning just after the elections in November. I think what the inflation numbers today, and I think it was reflected in the tone of Powell, is that the probability that if this continues, then maybe September opens up. There's a probability of that. And maybe instead of 1 cut, you could get 2 cuts. But if you look at both the SEP and even our own forecast, we still have broadly 9 cuts till the end of 2026. So I think that the key takeaway is that we are still playing around with the start of the easing cycle. No one is talking about removing the total number of cuts. So I think that's the good news. It's just that it is, when does it start? Does it start in September? Do we get 2 cuts in 24? Or does it start in November or December and we get 1 cut in 24? So that, I think that's basically where the debate is.
Okay, but let me come to the yield. The US 10-year yield, will it continue to remain higher despite of this promise of cut? Because fiscal spending and the fiscal deficit is still very high.
You are asking questions that are very difficult to answer at this point. And the reason being that, look, we have probably about July where the Fed is going to be important. Once the Republican convention takes place in July, we go into a completely different world where the market and analysts and everybody else is going to start focusing on the US elections. So fiscal spending doesn't really matter for 2024 as much as it matters for 2025. And I think that the US election is going to dominate not only the views about US assets, but almost certainly is going to start dominating EM and EM assets, including India. So I think that, in terms of the answering to your question, will fiscal policy dominate? Well, it depends on what will the elections results suggest. In the case of Biden, we have a certain idea of what the fiscal policy will look like. It's going to be more tightening in 2025. But if Trump comes back in 2.0, then I think that's a completely different ball game as far as fiscal is concerned. But it's not just fiscal, Latha. It is immigration. It is the fact that we don't know what actually will materialize. He hasn't spoken about policies, but he's talked about 60% tariffs on China and 10% tariffs on the rest of the world. Now, these are major shifts that will take place in economic policy. And let's not forget that he can also change the geopolitics in comparison to what the Biden administration's view was about geopolitics. So those are very big events. And I don't think any one of us are grappling with it at this point in time. We are still focused on the Fed. But my point is that it's probably up to July 15th when the Republican convention takes place. And that's about it. And then we'll all focus on the US elections.
Okay. Yeah, I know this looks scary. The whole geopolitics and tariffs can change. But let me come back to the Fed. As the Fed signals higher for longer, do you think that there can be any more financial accidents, like, commercial real estate loans of regional banks flopping?
I mean, there are always problems. If you want to look for concerns, there are always concerns. But look, we have gone through 4 plus, 4.5 plus almost interest rate for a long period of time. And we've seen that, when there have been problems, which was back in, 23, when we had the regional banks crisis, the Fed did come up with a set of liquidity supporting instruments. If you move away from yields per se, and you look at the broader financial conditions index, if you look at the equity market, if you look at spreads, whether it's high yielders or investment grade yielder spread, or even GBI EM spreads over the 10-year rate, these are at its lowest. So broader financial conditions are not only easy, they are easing as we speak, even though the 10-year yield is probably telling you a different story till about yesterday. Today, after the inflation print, is telling you a different story. So I think, even if you do get a start of an easing cycle, I don't think that the 10-year is going to reflect a lot of that, because a lot of it has to be priced in already in the 10-year.
Okay. Well, let me come to India now. Now, the inflation, even we got lower than expected inflation. So now the inflation differential between India and the US is shrinking. US core is at 3.3 and India's, headline is 4.7, but core is only 3%. So what are the implications of this narrowing inflation differential for yields and currency?
I think that, apart from the usual implication, what it does to real effective exchange rates, which RBI seems to have been targeting implicitly, even though it will deny that it's targeting real effective exchange rate, it's kept it completely stable. I think that's about it. That's about the only direct implication. But I think indirect implication is, what does a 3.1, 3.2 core inflation tell you about the state of the economy, as opposed to what CSO's growth data or national accounts data is telling you about the state of the economy? It's telling you two completely different stories. If you truly take the inflation numbers at its face value, then for the last 7 months, core inflation has been declining. It's the lowest we have seen since this index was started in 2012. And most economists will look at this number and say, not only is there excess capacity in India, that excess capacity is actually widening, not narrowing. That's not what the CSO's numbers are telling you, at least not on the face of it. But if I come to tell you, Latha, that, there is this economy which last year nominal GDP grew at 9.5% and CPI grew at 5.5%, you wouldn't immediately say that real growth in that economy was 8%, would you? But yet we have a CSO which tells me that nominal GDP is at 9.5%, we have inflation at 5.5%, and because of the very peculiar way in which CSO deflates service sector, nominal service sector, and parts of manufacturing with WPI, we get this very strange situation where you have an economy that seemingly is growing at 8% by the numbers, and then you have inflation telling you, no. Not only is there excess capacity is widening. If you even dig even a little deeper into CSO's own national account statistics, it will tell you that services inflation was 1.9%. Services inflation is doctors' fees, school tuition fees, telecom fees, restaurant charges. You use that on a daily basis. You tell me whether you truly believe that services inflation was 1.9% last year. But that's not the most egregious part.
Yes.
The most egregious part is, by CSO's own data, manufacturing inflation was minus 1.7% last year. We worry about deflation in China. By CSO's data, we should be worried about manufacturing deflation in India. So I think that it is very difficult to look at these inflation numbers and growth numbers and the the inside of the granularity that is the basis of the GDP numbers, that the national accounts, and have a very clear sense of the direction of policy or direction of the economy, and therefore the direction of policies. I mean, you're asking me a question about, I'm guessing, is that what is the direction of RBI policy? What is it? How can RBI even make a decision if that's the kind of messaging it is getting from growth numbers and from inflation numbers?
The WPI part, the fall in subsidies last year actually distorted the GDP. So I take your point about the GDP numbers being exaggerated.
I'm not even going there. Even without going there, even if you stick to GVA, we have to have it has to pass a smell test. How can manufacturing inflation be minus 1.7% in India in fiscal year 24? That's what the growth numbers are telling me.
Okay. That's a WPI high-based distortion. Okay, that's not the topic for today. As you expected, my next question, when do you expect Reserve Bank to cut rates?
Right. So the DNA of every policymaker is being confronted with this kind of data to err on the side of caution. If you don't give me clarity in the data, I'm going to err on the side. Fed is doing exactly the same thing. They're not getting clarity on inflation. They're not getting clarity from the labor market. Therefore, they're erring on the side of caution and holding. I think that Reserve Bank will do exactly that. That they will err on the side of caution and they will turn conservative, whether it is appropriate or not, which is, I think, what you intend by that question. Is it appropriate to cut? Of course, it's appropriate to cut. If you have core inflation 3.1% and you have rates that are real rates about 200 basis points above that, of course you have to cut. But you can't cut because there is no clarity in the data. So my sense is that until and unless the Fed cuts, and gives them that space, which they can then say, well, financial stability is not going to get impaired. I don't think the RBI cuts. But this is not because, macroeconomic fundamentals is telling them they shouldn't cut. It is just that there is very little clarity in the data for them to say, just like the Fed, that we are okay cutting rates.
It might interest you that the former statistician T.C. Anand has written about the WPI issue even today in the Mint. But anyway, let's come back to growth. What's your growth forecast for India in the current year and maybe next? Also, how do you see the rupee panning out?
We're looking at in a growth rate about, look, all of us do exactly the same thing. We just try to forecast what the CSO will print rather than what the growth rate is going to be. And just by looking at global commodity prices and how that is going to impact WPI, growth is going to arithmetically slow, even though there is no change in the economic momentum in the economy. And so we are probably headed towards somewhere around 6-ish or even below 6-ish if WPI starts rising because global commodity prices rising. That's almost an arithmetically given to us. So that's what we're looking at. Rupee, I think, is hostage to the Fed policy. And it is hostage to the Fed policy and the very small spread we have over the Fed. And I think as long as that policy, as long as the Fed doesn't cut and the dollar does not weaken by itself, I think the rupee remains under stress. And again, every emerging market country is under stress because of that. Look at what's happening to Brazilian real or to the Mexican peso. At least we are not in that space, at least.
No, you're not. Thank you very much, Jahangir, for staying up for us and for your very interesting comments. We have to do how the WPI is distorting the GDP as a separate show. But Indian rupee is safe, obviously, because the flows are excellent. On that note, we wrap up on Bazaar Chartbusters up next.